G'day there guys, my name's Phillip Wong. Today I have Bill Mavropoulos, who is a tax manager from Consulting.
Hello.
And he's going to help us out with a tax problem. Specifically, how can you structure your mortgages to make sure that you've got the best tax position that you want? Thanks very much, Bill, for being here today.
That's all right.
We've got two clients here, Jack and Diane, a married couple, and their problem has to do with the way they've structured their loans. Jack and Diane have jointly purchased this house. They bought it 5 years ago for $200,000.
Sure.
Today, their unit's doubled in value, so it's now worth $400,000. Congratulations, guys. Time to have kids, so it's time for them to move to a bigger house.
Sure.
The problem is that they've nigh on paid off that $200,000 worth of loan.
Mm-hmm.
They'd like to be able to move from their old house, buy the new house, yeah, and negatively gear this one. But I understand they can't. Why not?
Negatively gear is a colloquial term. What it actually means is the interest and other deductions on this property are actually above and beyond the amount of rent and other income that this property would have earned.
So why can't they borrow $400,000, which is the value of this house now, right? So they've got a $400,000 loan for a $400,000 house, take that cash and turn it into new residence. It's a deductible property, so the loan's deductible, right?
No, unfortunately, the test for deductibility in this case, in terms of the liability that's sitting on this property, is what are the funds that are being borrowed being used for? So where those funds are used to improve this property or to purchase this property that's being used to derive rental income, then yes, you would have been right in that case. The deduction would be claimable.
But
however,
yeah,
where those funds are being used to purchase a sole or primary residence that isn't being used to earn assessable income, that deduction is not available.
So it doesn't matter the fact that it's secured over a rental property, it's being used to buy a
That's
main
correct.
residence.
So
they're pretty much screwed. Is there anything that we can do to help them out here?
In terms of being able to structure this in such a way as they can negatively gear a property, that would depend on the facts and circumstances of the case.
So option number one that Jack was discussing with me in my ear prior to filming this was, because this is debt paid off, sell this property, buy their bigger property, and also buy an equivalent property somewhere else. All right.
Sure.
So option number one is to liquidate and rebuy again, and that's not so great because stamp duty.
Well, look, really, there's a couple of costs associated with doing that. The first is the real estate agent fees on the sale of this property and obviously the purchase of the new property. Now, the real estate agent fees on this are obviously payable by Jack and Diane. The real estate agent fees on the new property that they're purchasing, payable obviously by the seller there. However, having said that, Jack and Diane would also be liable to pay stamp duty on the new property that they purchase, even though when they sell this, obviously the purchaser would pay the stamp duty on this property.
But it's still a dead weight loss. It's stamp duty that they otherwise would not have had to pay.
Essentially, it's transaction costs. Anytime you're selling that asset, you're fronting up for those transaction costs. That's correct.
So we want to try and avoid those transactions costs, which can go from 5, maybe even to 10% of the unit. Like they're bleeding a lot of cash to sell it all.
Correct.
Can we do better?
Depending on how aggressive Diane and Jack are, they could potentially have their cake and eat it too. So let's tweak the facts to see what we could have done with this property. Diane is the smarter of the two out of Diane and Jack, which is often the case for the wife. So Diane, with her foresight, has purchased a unit for herself. She then met Jack. 5 years down the track, they're looking to move into a new property and start a family. The thing is, Diane, being diligent, has paid off the majority of her debt on her unit, which means that if she was to redraw funds off this loan, it would mean that she couldn't get a tax deduction for the funds that she's drawn to use them on this new property. What she can do is sell the property to Jack at market value, Because Jack is her spouse, they would be exempt from stamp duty on that sale. Also, because this was the main residence of Diane, on the transfer to Jack, it would be exempt from capital gains tax. Jack would then borrow funds to purchase the unit, pay those across to Diane, who would then use that money to fund the purchase of their main residence.
So originally when our clients walked in, they had joint ownership and they were a bit snookered essentially, right? But if we had changed the facts slightly by making that one or the other partner owns it, you sell it to the other partner, extinguish the original debt, the new debt becomes tax deductible because it's a new, for the purpose of buying a now investment property.
Correct.
And the old cash is then being used to buy the main residence, the new main residence.
The important thing when you're considering this strategy is what are the use of the funds being put to? When Jack borrows the funds to purchase this unit and provides them to the seller of the unit, being Diane, it is clear that the funds are being used to purchase a rental property for Jack. So when we do tweak the facts as you've suggested, Phil, and Diane is the sole owner of the property, it gives us a unique opportunity to potentially make the debt on this house tax deductible. The way that we make the debt tax deductible is for Jack to borrow the funds to purchase the unit. That sounds a bit circular, doesn't it? It sounds like, hang on a second, Jack already kind of owns this property because he's with Diane. So why would he be offered a tax deduction for money borrowed to purchase the unit? The way that the Tax Act works is it taxes specific taxpayers. It doesn't tax a family. So because Diane owns this property, were she to sell it to Jack, even though they're in a relationship, if it's at a market value, the transaction will be taxed in accordance with the Tax Act. One of the provisions of the Tax Act is the main residence provisions in Division 118. What they say is if you live in a main residence and you sell it or dispose of it by some other means, for example, transferring it across to your spouse, it would be CGT free. There would be no capital gains tax. So even though the property started at, let's say, 200, let's say the property started at 200,000 and has gone up to 400,000, even where you transfer it from Diane to Jack, the capital gains tax that you would pay on the gain of $200,000 would still be zero.
So the other beautiful thing about this is that by selling from the wife to the husband now, originally the wife took out a loan at $200,000 for the unit, but now he gets the deductions over $400,000 worth of principal.
Correct. And look, at this juncture, I'll just say, I'm undertaking this analysis in Victoria. So the Duties Act of 2000 applies. There's a specific exemption in that Duties Act that exempts from stamp duty any transfer of property between a husband and a wife or domestic spouses. Any transfer between the two is exempt from stamp duty in Victoria.
Now, I just want to point out for the audience as well that family law, tax law, commercial law, these are all separate buckets. I'm sure I'm going to get a comment below in these YouTube videos asking, well, what if they get divorced? For family law, it doesn't matter whether it's the husband or the wife who owns the asset. At family law, it all goes into the bucket and the judge will decide from there. So our options are liquidate everything and then buy new houses, which is pretty crummy in terms of transactions costs. Or if we had one partner that owned it and not the other, then we can simply swap it across.
Correct.
Is there any other options we've got available?
Look, there are other options available, different variations of that. For example, if one partner was to transfer it to a bare trust, with the trustee being the other partner, held absolutely and beneficially for that spouse, that could also work from a stamp duty perspective and obviously from a CGT perspective as well.
So following on from the bare trust idea, it doesn't actually have to be a sale between a husband and wife, right? So let's say that Diane's father is here, right? So they could establish a bare trust in the name of the father in order to achieve exactly the same comment. And that means that you've got more options there.
Okay, in order to clarify the bare trust option, Phil, you are correct. Diane's father could very well hold the property in trust for his daughter Diane, absolutely and beneficially. That would mean that effectively the property is held by Diane, but legally has transferred to her father.
They will trigger a CGT event at that point.
Correct. There will be a CGT event triggered. However, because the property has been lived in by Diane,
Main residence rules.
it is still a main residence.
Awesome. And the final option here is to play with offset accounts.
Offset accounts are often linked with a loan, and basically what they do is minimise the amount of interest that is payable on that loan over the life of that offset account. So essentially, let's take their situation, and let's say that there was a loan of $150,000. If they had in their offset account, which is just another bank account that's linked to that loan, $50,000, that would mean that they would only pay interest month to month on the net amount, on the $100,000. But there's one benefit of having an offset account. It gives you access to the amount that's sitting in the offset account without affecting the deductibility of the ultimate $150,000 loan. It in effect means that the use to which the funds are put is no longer a consideration for when Jack and Diane move out of the property.
So just checking to make sure I got this straight, right? So if Jack and Diane were, instead of to pay down the debt, they would have taken out an offset account, and they pay the cash back into the offset account rather than paying back the principal. That means that the original loan that they have taken out is still available there. And when they withdraw the offset account, rather than actually paying a loan off and then taking out essentially a new loan, that offset account is totally cool to buy their new main residence. And the original loan is now deductible.
Correct. This is a quirk of the tax law. The money in the offset account actually is not part of the loan itself. So technically speaking, the funds that are sitting in that loan account aren't being touched when the money from the offset is being withdrawn and allocated to this purchase. Therefore, 100% of the interest on that loan would still be deductible.
So it seems like Jack and Diane do have a bit of a tax problem here, but the problems are not insurmountable. I think the better option here for Jack and Diane, rather than try and fix their current problem, would have been to come and see Bill at Carassa Consulting to start off with, and they probably could have structured their loans a bit better to make life a bit easier later on.
Jack and Diane's case is not unique. Often people that have purchased an asset and then are looking to make a significant life change like purchasing a family home run into tax problems because there is a difference between what the banks want you to do and finance and what the tax law wants you to do and deductibility. When circumstances in your life change or you're purchasing a significant asset like a family home, it's always advisable to seek the guidance of a professional in that space.
Thanks very much, Bill. Good to see you again, man.
Lovely to see you again.